Very good afternoon and welcome to our webinar for today called How to Invest in 2016. Let's get straight into it. As you may know, today we'll have Roger Montgomery, who is the founder of Skaffold, and he was also our founder of Montgomery Investment Management. He's going to share his strategy and approach as a fund manager, plus a few stocks for 2016. Now, I know we're all excited to hear those. And we also have Chris, who's the general manager and also founder of Skaffold. Now, he's going to share his strategy as a self-managed super fund investor, plus the themes that will drive growth. Now, if you're ready, I'll throw the first question to Roger. Hey, Roger, the very first question is, how do you build an investment strategy that can withstand volatility? We've seen a lot of it going on around this year. 2016, what do you do?
Look, what you do in 2016 is exactly the same as what you do elsewhere in terms of market cycles and also through the years. And the answer is really quite simple. We've got one answer to it, I should say, and it's not the only way to do it. But the way we do it is simply three things. One, we focus on quality. So it's imperative that we're buying businesses of the highest quality. Generally, that means companies with a high and forecast to be stable return on equity. So we're looking for businesses that have bright prospects for their return on equity. And we're also looking for businesses that quite simply have bright prospects for their products and services. The other thing that we do is we buy only when companies are cheap. Now that is one of the hardest things to do because we're looking for companies that are cheaper than their value, and that means that you have to be very patient. And the third thing that we do is we hold cash. So if we turn to the next slide, here's an example of a business that we don't think has very bright prospects. This is a DVD rental kiosk that is owned by a company in the United States called Outerwall. They have 43,000 of these red box DVD vending machines. And if you ask yourself the question, do I think people are going to be hiring more of their entertainment through a DVD vending machine or less? Clearly the answer is less. So this is an example of business that we don't think has bright prospects. The other thing that we do is we focus on businesses that, as I said earlier, have high and sustainable returns on equity, but also have the ability to retain large amounts of their profits and grow them at that high rate of return on equity. So here I've got three companies up. We've got M2 Telecommunications, Telstra, and CSL. And what you'll notice is I want you to imagine for a moment you put $100,000, we'll just pick two of these, $100,000 into M2 Telecommunications and $100,000 into Telstra. Now, one of the things that you'll notice is that the yield in 2005 on Telstra was 5.97%, which is a lot more attractive than M2 Telecommunications' yield of 3.91%. So on $100,000, Telstra was giving you income in 2005 of almost $6,000, whereas M2 was a couple of $1,000s behind that at $3,900. But there's a difference between these two companies. Under Sol Trujillo, Telstra was paying out about 100% or a little bit more than 100% of its earnings as a dividend, whereas M2 Telecommunications was retaining a lot of its profits and compounding at a very high rate of return on equity. Now, both companies had attractive returns on equity, but M2 was able to retain profits and compound that return on equity. So if you fast forward to 2015, the $100,000 invested in Telstra grew to $117,000, and your income of $5,970 grew to $6,500. You can see that at the bottom of the middle column there. But look at M2. The only difference, of course, being that the company was able to retain profits and grow the value of the business. And so $100,000 grew to $3 million, and that $3,900 of income has grown to $99,800 on an original $100,000 investment. So the point I'm trying to make here is that the businesses we're looking for are businesses that have high rates of return on equity, but also the ability to grow by retaining profits and compounding it. And you can see that on the next slide. If you look at the difference between the growth in the dividend, which is the green line, and the subsequent share price performance, you can see that in the case of CSL, good growth in income because they've been able to retain and compound profits, and the share price has done phenomenally well. Have a look at the next example, which is M2 Telecommunications. Again, good growth in income because they've been able to retain and compound those profits, and subsequently very good share price returns. If you have a look at Telstra over the same period of time, virtually no growth in income, and you can see the share price is lower than where it was back in 2000. And so it's important to look for growing income, not just high dividend yields, and that will certainly be the case in 2016. And of course, if you go to the next slide, you'll see that what we're trying to avoid are businesses that have terrible economics. So here's an example. Imagine for a moment, and I'll take you through these numbers now very quickly, but imagine for a moment that you owned this business and you asked me to run it for you. So you put in $393 million in 2004, and we go down to the bank. I'm going to run it for you. So we go down to the bank together and we borrow $500 million. You can see that in the first column, 2004. And after running it for a year, I report back to you a profit of $158 million. Now that's a return on the equity that you put in of about 40%. So obviously you're really delighted with that. You're very excited about that. So you let me run the business for another 10 years. You come back after 10 years and you say, Roger, how's the business you're running for me going? And I report now a loss of $353 million. Now, by the way, all of this has come from the capital history screen in Skaffold. So what Skaffold does is extracts the relevant information from 10 years of annual reports to show you the story of what it would feel like to own the whole business. So now imagine 10 years later, I'm reporting to you a loss of $353 million. The loss before that, the year before that, was a $100 million loss. Year before that was a profit of about $40 million, but the year before that was a loss of $66 million or thereabouts. So you're not happy anymore. What if I then told you, in addition to profits declining, that you've actually been putting more money into this business to grow it? So you've now put $1.1 billion or $1.147 billion into this business to expand its geographical reach, to expand the customers that you're servicing, to expand your plant, machinery and equipment that you're servicing those customers with. This is an unmitigated financial disaster. You would then probably ask me, well, Roger, I hope you've paid off the debt, the $500 million. Remember, we borrowed $500 million 10 years ago. Hopefully, at least we don't owe the banks any more money. Well, in fact, you owe the banks $2.5 billion now. So this is an unmitigated financial disaster. And the number that is being produced now is a return on equity of minus 30%, but more importantly is the next column, the change. And what you can see there is that the capital has gone up by, the equity you put in has gone up by $554 million, but the profits have declined by $500 million. So that means every dollar you've put in the business in the subsequent 10 years has lost 67 cents. You do not want to own a business like that. So we can avoid those businesses by simply avoiding the C-rated companies in Skaffold and companies with performance scores of 4 or 5. And you'll find that Virgin Australia Holdings, which is what this business is, has a very low quality rating on Skaffold. More importantly, though, if we change the slide again, you can see there's a good relationship between the share price and the economic performance as described in Skaffold's capital history screen. So you can see here 10 years ago, the share price of Virgin Australia Holdings was about $2.50 or thereabouts, and now it's closer to 40 cents. And that's true because in the long run, the market is a weighing machine. In the short run, it's a voting machine, as Benjamin Graham described, but he also said in the long run, it's a weighing machine. So it's very important not to be in the market. You know the phrase, invest for the long term. Everyone tells you invest for the long term. Well, that's only true. That's only true. Time in the market is a good thing when you're in good quality businesses. You need to avoid the poor quality businesses. So this quote here from Warren Buffett now makes a lot of sense. Time is the friend of a wonderful business, but the enemy of the mediocre business. The longer you're invested in a poor business, the worse it's going to get. And let me tell you what inspired the capital history screen in Skaffold. It was literally a quote from from Warren Buffett, where he said, if you're not prepared to own the whole business for 10 years, don't own a little piece of it for 10 minutes. In other words, what he was saying was, if it wouldn't feel good to own the whole thing for a decade, it's not going to feel good to own the shares, and you shouldn't buy the shares. And so the capital history screen is there to inform you about the businesses to avoid. So in 2016, I'm going to give you a list of some other surprising businesses that have similar share price performances over 10 years. So if you have a look at BHP, you can see since 2006 the share price is unchanged. In fact, the share price is now about $22, so the shares are back to where they were in 2005. So 10 years of no positive share price performance from BHP. Same thing from Rio Tinto there. You can see no improvement in the share price over 10 years. CIMIC, which is the old Leighton's Holdings, again, share price back where it was in 2007. National Australia Bank might surprise a few people. Share price back where it was, we're talking 16 years ago. No share price improvements. This is a so-called blue chip company. And the only way the share price could have done nothing over 10 years is if the value has done nothing. And the only way you can destroy value is by not generating an attractive return on your retained profits. And that's certainly been the case over at National Australia Bank. And the capital history screen will show you that on Skaffold. Here's another one, Telstra Corporation share price lower than where it was back in 1999. So 16 years and no positive return. And that's because Telstra's profit is precisely where it was 10 or 12 years ago. AMP, another one, lower share price performance, going back a very long time, about 16 years. And our final example, Boral, you can see despite all the excitement about a recovery in construction in the United States and the building boom going on in Australia, yes, the share price has gone up since 2012, but if you go back further, the share price is unchanged since about 2004 or 2005. Now, all of these companies have been variously described as blue chip companies, but I reckon that's the only blue chip that we're looking at in that suite of companies. And fortunately, and this is what makes Skaffold such a useful tool, it's going to help you filter out those companies. Some of you listening today and watching this presentation are going to be thinking about some of those blue chip companies as an opportunity for gains in 2016. But the way I think about it is I'm less interested about owning poor quality businesses and more interested in owning high quality businesses irrespective of what's going to happen next year.
Wow, that's very mind-blowing, Roger. Now, Chris, I want to bring this closer to home and bring into the discussion. Roger's brought up some very interesting tickers, some that we know are very darlings to people's hearts. Now, can you apply the same strategy and can you look at things the same for your self-managed super fund?
Yes, certainly, Shepard. You can certainly do that. One of the keys to running a self-managed super fund is, as Roger has rightly highlighted, you need to focus on quality stocks. And in order to do that, you need, you either need an enormous amount of time to do the research yourself, or you need a tool that's going to help you do that. What we look to focus on here at Skaffold is a tool that helps you filter out some of those not so attractive stocks quickly and easily, and so you can then drill down and focus on the ones that really are worth looking at. So, Shepard, you asked the question at the start, what do you do to withstand volatility? And I wanted to bring the perspective of, say, a retail investor, someone with just a small amount of money to invest. And a key thing is to focus on diversification. What I do when I'm running my own self-managed super fund is I really do try and stay diversified, and I do that across a number of different ways. Firstly, I look, of course, at the type of business, the industry that it's in. I also look at the size of the business, so I don't want to have my whole portfolio in small caps, nor do I want to have the whole portfolio in large caps. So I try and spread it across different size businesses. I also even spread a little bit across investment style. So I'll have a little bit of income, a little bit of growth, and primarily I'm focused on value investing style. And lastly, geography. I have the majority of my portfolio in Australia, probably 70%, but I've also got investments in the United States and the UK, and I've used Skaffold to help me source the appropriate stocks there to invest in. For most of us, we're kidding ourselves if we think that we can do that. Many of us have careers and family life and so on, and so we don't have the time just to go into that much detail. The thing about diversification, of course, it reduces the risk of something unexpected happening, which will have a detrimental effect on your portfolio, but also what people sometimes forget is it increases your chance of catching a winner. If you're invested narrowly in just a handful of stocks, and the one that you were thinking about investing in but didn't is the one that does really well, well, you've missed out on that opportunity, and that might have been the one that really made your portfolio.
All right, Chris. So what rules do you apply when you go through the strategy?
Okay, so things that I like to do, I like to have a very systematic approach. So I focus on rebalancing my portfolio at least annually. Often it's more frequent than that, usually just after reporting season, so half annually. I also aim to be equally weighted across the stocks in my portfolio. And if I get a stock that does really well and is therefore growing in terms of its position in my portfolio, becoming what they call overweight, then I'll trim that exposure, or I'll sell some of that stock. And a very pertinent example is just earlier this week I sold some of my Certex shares because Certex has done really well and was starting to become a significant chunk in my portfolio, and so I sold some.
Thank you very much for joining us today. Thank you very much, Roger, and thank you very much, Chris.
It's a pleasure.
And see you guys next time.
Investing in shares can be rewarding when you do your research, but it can also take up a lot of your time. There's so much information out there. How do you quickly sort through the companies worth investing in and those to steer clear of? Skaffold is my research tool of choice. It tracks and reports on all ASX listed companies, plus thousands of global stocks daily, helping me decide which stocks to buy and sell. I can quickly filter through the reports to get the information I need. The rating system is like a set of traffic lights for the stock market. Green is good, orange is caution, and red is don't go any further. Skaffold's top stock choices have been highlighted for their outstanding performance by Money Magazine. With Skaffold doing the work for me, I have the confidence to make investment decisions without having to spend hours sifting through financial data. Now you can take control of your time and your portfolio. Why not take Skaffold for a test drive today?